and welcome to another episode of Desi Fire Podcast. Today, I wanted to talk to you about a topic which is getting a lot of traction, at least on social media, is that should you cancel your small cap SIPs? First of all, I did. I did stop them. And the agenda for today's session is primarily this. I'll talk about what are the actions that I have taken, what is the historical data, what does that tell us, and most importantly, what should you do? So first of all, what have I done? I stopped my STPs. So I was not really running an SIP. I have no income coming in. I have funds in debt funds. I was doing a systematic transfer plan in small cap funds and in mid cap funds. I have stopped that. I've decided that I will not be selling the funds that I already have in small and mid cap, and I'll probably buy more if and when the markets fall further. Now, what's the idea of these small cap and STPs? Well, so I had HDFC Nifty Small Cap 250 Index Fund. It was a direct fund growth option in which I was running an STP of daily 6,000 rupees daily. So you can see that 30,599.70 because when you transfer 6,000, a small duty is stamp duty, I believe is what is called, is deducted. So this was the daily STP which was going on. HDFC also provides you an option called the Flex STP, which means on the days the value or the NAV is lesser, it'll actually invest more than 6,000 if required. And that's the reason why you would see on some days 8,900 was invested and on some days 11,800 was invested and so on. It sort of takes off advantage in case of a market fall. The mid-cap STP that I had running was an HDFC Mid-Cap Opportunities Fund. Once again, it was 6,000 daily and the last investment that I made was on 31st of Jan 2025. Here also you can see a little bit of a variation here, 9,700, 6,200. That's again because of the Flex STP feature that exists. So first of all, why did I pick these funds? The primary reason is that my debt funds were already in HDFC and so starting an STP would be simpler. Mid-cap opportunities, why did I pick that? It's a very big fund, popular fund from the house of HDFC. So I didn't really want to think too much about which fund to pick. I don't really think that picking a fund is going to make that much of a difference either. So I picked that. Now, because I picked one active fund, I thought the other one I'll probably pick up an index fund. So that's why I picked up the small cap index fund. The method that I chose was a Flex STP. It is not an SIP. An SIP will take money out of your bank account and then invest. Probably works better for people who have income. STP is when you transfer funds from one to another. And Flex STP is essentially some sort of an algorithm that these guys use such that if the NAV falls a lot, they buy a larger quantity. And that's what you would want, right? When the NAV is lesser, you buy a larger number of units. What is my current split? The current split is I have very little in mid and small cap, 3.3% out of a total of, I'm looking only at my equity funds. Flexi is little less, large cap is fairly high. So why did I stop? Multiple reasons. A, I was concerned about the valuations which exist. Why was I concerned about the valuations which existed? Because I don't know much, but I listened to a lot of people, a lot of experts on the topic. And I especially listened to Narain. If you notice, the STPs that I stopped, I actually stopped them on 31st of January. The video became viral sometime in, Narain's video became viral sometime in February. But the actual speech that he had given was on 20th of January. And Narain has been talking about, high valuations for a very, very long time. So that was one reason for stopping. The second reason for stopping, which was a conversation that I had with my financial advisor, where he said that, Handa, the only reason you are investing in mid and small cap is because you want a check mark that, yes, I am invested in all sectors. I have a nice looking portfolio and all of that. Is that more important than making money? To me, it is not. What matters more is getting the best returns out of it rather than having a better looking portfolio, so to say. And that's why I decided that, okay, I'm not going to, invest more in mid and small cap right now. I would rather put this money elsewhere. So I'm not putting money in mid and small cap. Obviously, I'm buying the dip because the markets are a little bit lesser. I do have some opportunity fund. I am sitting on some sort of cash, but I'm not buying that in mid and small cap funds. I'm buying it elsewhere. To be precise, I'm buying the ICICI equity and debt fund, sort of a hybrid, aggressive hybrid fund. Secondly, what I've also done is I have earmarked funds for future that, okay, this portion of my money will go into mid and small cap funds at a later date. So I will be buying mid cap and small cap. It's not that I don't believe in them or I don't think they're a good idea. It is just that now is not the good time to buy them. I will buy them in hopefully near future. So that's why I stopped right now. Now let's look at some historical data and try and make a case of whether you should invest in it or not and how bad the situation really is. First of all, small caps have been traditionally very, very volatile. This is a table that I picked up from Value Research. And what this table talks about is, in one particular year, what is the highest return you got? What is the lowest return you got? And what were the returns for that particular year? So if you pick up any random year as an example, and you want to see what the returns are, 31, 56, minus 62, 99, 19, minus 26, 45, plus 89. And this is the data for 20 years, 9, 5, 50, minus 17, minus 1. It is very, very volatile. But what's more interesting to me is that in the same year, there could be a very, very different experience that you can have depending upon when you purchased and when you sold. What I'm trying to say is, let's look at an example of 2007. The lowest return someone would have got is minus 13%. So someone invested in 2007 where the funds actually gave a 56% phenomenal return, but someone still lost 13% on the way. Someone lost 20% in 2009, whereas actually in the entire year, there was someone who made 99% returns on small cap funds. So even within the same year, your return can actually vary quite largely. So minus 13 and 56 is there. I have minus 20 and 99. Do we have some more data? Say minus 36 as well as plus 24% have happened in the same year. So how do you know when to buy, when to sell? Because every year will have all this volatility. As of now, I believe the funds have fallen. I'm recording this on 15th of February. I think the small cap funds have fallen something like 16, 17, 18 odd percent. At least that's what I remember as the headline number. In that case, there were multiple. So in 2022, it happened. In 2020, it happened. In 2018, it happened. In 2016, it happened. Every 2-3 years, it happens that the small cap funds fall by that much in point A to point B in the same year. Should you still really be worried? Well, that's a question for you to answer, and we'll try and bring some more clarity to it in the later slides. So this is the reality check. Once again, from Value Research, they talk about the Kotak Small Cap Fund. It lost 38% in 2006, 9% in 2009, 30% in 2013, 25% in 2018. And it has only lost 18% this particular year. 18% is a lot. I'm not denying it. But things can get far worse. Things have gotten far worse in the past. Maybe that is the reason that I am waiting. Or maybe that is the reason you should wait. Once again, what you should do, I'll come to it. I've built some sort of a thought process which might be helpful. Is it worth the risk? Yes. Because if you look at the 10-year average rolling return, that's 16.56. The best rolling return has been 24.72. And even in the worst possible case, your 10-year rolling return has been an 8.4%. Which means that, at least in the data that Value Research has considered for this, which they have not really shared what data it is, any 10-year period you pick up, you would have made at least an 8.4% return in this particular. I think it's for the last couple of decades is what they are looking at. But couple of decades have been really, really good. Does that mean going forward you can expect the same? Well, you never know. And that brings me to the question, what should you as an investor do? Well, before we get to what actions you should take, some basic facts which I hope you know and you should know is small cap funds essentially invest in stocks of relatively smaller companies. These are not small companies. These are relatively smaller companies to, let's say, the HDFCs and the Bajaj Finance and Zomatos of the world. They have a market cap of at least, I believe, around 10,000 crores to get into the small cap 250 index, and 10,000 crores is a lot. It's not your mom and pop store, or it's not a 100 crore company which is there. It's a 10,000 crore company. It's still a fairly big company. Yes, these companies in terms of prices are a lot more volatile than the bigger companies. But what you need to understand is that they're also strongly related to the stock market. It is not going to happen that the large caps will continue to rise and the small caps will continue to fall. No, if the large caps are rising, the probability is that the small caps will rise at a faster rate. If the large caps are falling, the probability is that the small caps will fall at a faster rate. So the volatility which exists for, let's say, a large cap fund would be something like this. It would be a lot larger for a small cap fund. What do SIPs do? So let's try and understand the SIPs a little bit better. First of all, they're just a mechanism to average the cost. You don't really need to overthink as to, how much money to invest, when to invest. If you don't want to take all those decisions, you can just start an SIP, not be bothered with it. Look at it 5 years down the line, 10 years down the line, and you'll probably end up doing very, very well. So that's what an SIP does. But at the end of the day, what it is doing is it is averaging the cost. And if you end up buying things at a higher price, when you know that the price is high, obviously your overall average cost would be higher and your overall returns would be lower. So if you believe that the markets are really, really high right now, then you should not be buying it. Then you should be stopping your SIP. If you believe that markets are really, really attractive right now, then not only you should be continuing your SIPs, you should be dumping more money into it, pouring more money into it. But the problem is you don't know what's going to happen. And that is why you average. There is a theory that exists that nobody knows what is going to happen. And that is why everyone should average, and hopefully the average works out better. And that's the fundamental idea behind SIPs. The problem what has happened is there is a lot of misinformation that exists with respect to SIPs. And I've seen that in multiple places where people say that, oh, you just blindly SIP, don't do anything, don't think anything. You will get 15% return, you will get 12% returns. And, you can't do anything better than that. You should not try to time the market. A lot of it is true, a lot of it is false, depending upon how much exaggeration is built into the conversation. So there is no absolute truth that exists. And that is probably why the current situation has risen. S. Narain, who is the Chief Investment Officer at ICICI Mutual Fund, he very recently gave a speech, which is probably the first time I have seen a mutual fund guy coming out, saying publicly, saying in the open, tell people not to invest. Please understand that it was an IFA event where he was talking to advisors. He was not talking to retail investors, etc. Even when he talks to retail investors, I have attended his monthly calls and market outlook. Even then, he has been saying similar things. But here he was very, very harsh with his words, or very, very truthful with his words, depending upon what point of view you are taking. Where he said that, not only you should stop your SIPs because these SIPs are not going to make money over 7 years, 10 years, etc. And no one continues these SIPs for 10 years, 20 years. The second part that I agree that no one is going to continue for 10, 20 years. The first part, I'm not very sure if these SIPs are not going to make money over a 10-year period. He also talked about getting out of the small cap and mid cap space, lock, stock and barrel. Once again, for a few people, it might be valid, but I'm not sure if that is a valid advice for everyone. And that is why context matters. The context is that he is talking to fund advisors and mutual fund financial advisors and mutual fund distributors who have been mis-selling, who have been telling people, boss, invest in SIP, you will make 25% returns. The problem is these mutual fund distributors, the problem is these independent financial advisors who have been mis-selling. And if I am making a product, I am making a t-shirt, and you sell this t-shirt saying that, oh, this t-shirt is going to, I don't know, make you look 10 kgs lighter, I would be angry at the salesman as well. Because what's actually happening here? He has made a product, he has a product, he has thousands of products, and people are pushing the product which is inappropriate for most clients. Because if your mutual fund distributor tells you, advisor tells you, put money in small cap fund, you will put it in a small cap fund. It will go to ICICI. ICICI now has to put that money into small caps. And that becomes a problem. And that is why his entire argument, his entire speech, I believe, was to tell the mutual fund distributors and the independent financial advisors to do a better job. Also, he was highlighting the fact that SIPs are not magic. and they are being sold as magic that you just do SIP and forget about it. He also wants to highlight the fact that the valuations are really, really high and you should be concerned. And even if you are doing an SIP at a high valuation, you are essentially buying something at a higher cost, which is going to push down your returns over the long term. And maybe you should not be doing that if the valuations are that high. And him saying all of that openly has sort of broken the code of silence in the mutual fund industry, because you will never find, or very rarely you would find, a mutual fund advisor actually coming and saying that do not invest. They take actions on this basis. So you look at a lot of mutual funds. Say, for example, I was listening to Sandeep Tandon of Quant Mutual Fund just a few days ago, and he talked about that even in their small cap funds, they have maintained only 65% of small caps, and the rest of the money they are not putting there because they don't believe small caps are going to do very well over the short term. He talks a big game. In the interview, he was talking about, no, you should keep investing in small cap, etc. But the actions that he has taken over the last month, 2 months, he's still maintaining that 65, a little above 65 in small cap funds. If he was so positive about small caps, like he is saying in his interviews, then he would be investing 70, 75, 80% in small caps. But he's not doing that. So you need to look at not just what people are saying, but what people are actually doing. Narain, on the other hand, if you look at, say, for example, a value discovery fund is something that he runs. Have a look at the composition of the value discovery fund. It is essentially a fund which can invest in large caps, small caps, mid caps, complete freedom to do that. There is no restriction, so to say. You look at the composition, you will find there is a very, very tiny percentage that's invested in small caps in that. And that's the point. He's actually doing what he's telling other people to do. So a lot of these people who keep saying that, no, you should keep investing, you should blindly continue with your SIPs. Yeah, there is some sense and some logic to it, but you should try and analyze what actions those guys are actually taking to understand what is their real view and what is it that they are saying. Now, for example, I just said that I have stopped my SIPs and STPs. Does that mean I'm recommending you to also do the same? No, I'm not. What I'm doing is I'm giving you some sort of an idea, some sort of a framework to help you decide what you should do. And this is that thing. Say, for example, ask yourself these questions and then maybe that will help. Do you have more than 50% in small and mid cap funds? If your answer is yes, I believe you should stop your SIPs. Why? Because you are overexposed to the sectors which the assumption is that they are at a higher valuation. Under most circumstances, not many people would recommend that more than half your portfolio is in mid and small caps. As of now, when portfolios have fallen, when mid caps and small caps have fallen more than the large cap, even now you have more in small cap and mid cap funds. That is essentially a problem. So I don't know whether you should sell it or not. Perhaps that is a discussion you need, or that is a decision you need to think a lot more about. But should you put fresh money into it when you're already more than half in small and mid cap funds? I don't think so. So, and if you don't, then what should you do? Answer the next question, which is, can you handle a 25% drop from peak? As you can see from the chart, where is that? Yeah. A more than 25% drop or around 25% drop happens very often. 2020, 2018, 11 it happened, and 8 it happened. So it will keep happening in your long-term portfolio. And if a 25% drop from peak worries you, if that becomes a cause of concern, then probably small cap and mid cap funds are not for you, because it will happen over and over again. So yes, just sell them. Get out of it, never get back in. Understand that this small cap, mid cap thing is really not for you. Or maybe reduce your exposure to a certain level that you're no longer worried about losing that 25%. Say, for example, suppose you have 2 crores in small cap and mid cap funds, and a 25% loss means it's a 50 lakh loss. Can you handle a 50 lakh loss? No, that's too much. I can't do that. But if instead of 2 crores, you had suppose an exposure of 20 lakhs in the small cap and mid cap funds, can you handle or would you be comfortable with a 5 lakh loss? Probably yes. It's not as much of a concern as a 50 lakh loss. Both percentages are still 25%. If you are such a rational investor that you're only looking at percentages, then it doesn't matter. But if you are someone who is looking at absolute values, if you are someone who gets worried at a 50 lakh loss on a 2 crore portfolio, then you should not have those 2 crores in small and mid cap funds. There are other choices for you. Figure out. And if you believe you can actually handle it, then yes, move ahead, try and answer the next question, which is, do you think that the markets are going to fall from here? I'm recording this video on Feb 15th. If you would say, I don't know what the markets are going to do, so you're not convinced one way or the other, please continue your SIPs. There is absolutely no logic to stop them. Maybe the markets are going to rise and they are going to fall. If you do not have a very clear view as to what the markets are going to do, there's no need for you to take action based purely upon what Narain has said, what X guy has said, Ravi Handa has stopped it, so I should also stop it. No. What is your view? If you do not have a conclusive view, please continue your SIPs. If you believe that the markets are not going to fall, we are close to the bottom and, so to say, it's done, then also you continue your SIPs. It doesn't really matter. Let it continue. Let it, compound for the long term. However, if you do believe that, yes, the markets are going to fall, we are at a high valuation, that is when you should probably go to the next question. I'm still not telling you to stop your SIPs or cancel your SIPs. The next part is, do you have a plan? Which is, what are you going to do? When are you going to stop? When are you going to start? What are the values you are looking at? You can't just blindly, because some guy is saying something, stop your SIPs. If you do not have a plan, then please continue your SIPs. However, if you do have a plan, then let's move ahead. Just for clarity, what do I mean by having a plan? So this is a sample plan. I'll collect all potential SIP installments in a liquid fund. So as long as I'm not investing, suppose I had a 2 lakh rupee SIP going on, I will collect that 2 lakh every month in a separate liquid fund. That's what, for example, I had that 2 lakh STP going on. If I don't continue it for a period of 6 months, it becomes 12 lakh rupees. I'll collect that 12 lakh rupees in a separate liquid fund. When Nifty hits 20K, I will buy the dip with all these funds that have been collected. Post that, I will restart the SIPs. So Nifty has a 20K, now let me restart the SIPs. In case Nifty doesn't hit 20K before the year end, then I'll restart the SIPs anyway in January 2026. I'm not saying this is a good plan. I'm not saying this is a bad plan. I'm not even saying that this is my plan. I'm saying this is a plan. You should have a plan if you are planning to stop your SIPs. If you do not have a plan, then please continue your SIPs. Do not touch it. Just ride it out. But if you are even thinking of doing something like that, stopping your SIPs, then you need to have a plan. My plan is fairly straightforward. I have purchased roughly 25% of whatever cash I had at Nifty around 23K. So I'm still in the process of buying it. Most of it is done, but I'll probably make a couple more transactions. I'll keep buying it as long as the market keeps falling, and I will be fully invested at 20K. That's what my plan is. Which brings me to the next question. Will you be disappointed if you are wrong? So you took a call that, yes, markets are going to fall. So it doesn't happen. How much disappointment will you have? If you think that you will be disappointed, you will think of it as a lost opportunity, you will think of it as a mistake, please don't do it. Continue your SIPs. There is no need to stop. On the other hand, if you believe that, no, it's part of the process, I take some decisions go right, some decisions go wrong, and it's not really going to have a material impact on my lifetime earnings or my lifetime returns to that extent, then you should cancel your SIPs. Once again, I'll just quickly say in what case should you do this. So, do you have more than 50%? Yes. Stop your SIPs? No. Can you handle a drop? Yes. Do you think the markets will fall? Yes. Do you have a plan? Yes. Only then will you be disappointed? No. Only then, if you checkbox all of these, if you say yes to all of these or wherever no was appropriate, only then you should cancel your SIPs. Otherwise, it does not make sense. Pause is the more appropriate term, because you're not cancelling it forever. You're cancelling it for the time being, and you'll hopefully restart it again. So conclusion, my actions are based on what my personal situation is. I have no income coming in. I have to live off this portfolio for a very, very long time. I have very little small cap and mid cap exposure, and I have an opportunity fund. Based upon all of that, I have taken the decisions that I've taken. Cancelling SIPs is not a good idea. It is not for everyone. It should probably be done by a very small portion of the people. Who are those people? Well, based upon those yes-no answers, probably you are one of them. Selling funds is actually for a very, very small minority. I can't even imagine someone who actually goes on to sell their small cap and mid cap funds in mid-February. Because what is the assumption that you're making here? A, you will sell them now where you believe we are already a little bit off the peak. B, you will be able to buy it again when it has fallen significantly more. And you will do this not just this time. You will do this again the next time the some sort of crisis hits small cap funds. You will do this again and again and again. Every time you will be able to get out at a higher value and get in at a lower value. Very, very difficult. I am not very sure how many people will be able to do it. If you think you can, then probably you should consider selling your funds. But otherwise, just continue your SIPs. That is the correct answer for perhaps 95% of them. And hopefully the other 5% who are watching will be able to make a much more informed decision now. Hope you like this video. In case you have any further questions, please use the comment section and don't forget to like and subscribe to our channel.